Napco Security, Arista Networks, and Brookfield release their earnings this week. It's three companies that I'm following with a small position, a small part of my portfolio in Napco Security. So we're going to see everything that you need to know about the earnings, and we'll have a look at the valuation, if it can be a good opportunity or not. So let's start with Napco Security. After earnings, the stock grew by 5%, and the year-over-year performance, it's still not the year-over-year, the year-to-date performance, sorry, is still minus 25%. So maybe it can present a good opportunity, but to be honest, I'm not a big fan of the earnings that Napco had. I don't really understand why they had plus 5%. On last earnings, they had minus 20% in a day. Here, plus 5%, and I find them less good than last earning. So here are some highlights from Richard Soloway, the CEO. We are pleased with our 30% adjusted EBITDA return and the continued strong gross margin of 91%. This is the first thing, 30% adjusted EBITDA return. Like, he's pleased with this, while it's a not really bad quarter, okay? They had a decrease in equipment sales, 10% decrease, but still, like, he is happy that finally they have 30% EBITDA return. Like, I don't really get the point here. Like, why you just don't focus on the fact that they are not selling anymore? Because yes, their recurring revenue service is getting higher, but yeah. Then the decrease in our equipment revenue for the quarter was primarily due to reduced sales to three of our larger distributors, two of whom were managing their corporate-wide existing inventory levels, and the third, which was driven by the timing of project work with their customers. So it's the same than last quarter. Okay, they had a problem, let's say, with distributors, but nothing saying that it will be better in few times. Okay, nothing saying that the company is working on it, that they have some new lead, okay, new opportunity. No, it just decreased because of this, and nothing to tell us that they are working to solve this. They're having new products, so this is good. In response about the tariffs here, in response to this uncertainty, we institute a price increase on all of our equipment products, and we'll continue to monitor the situation and adjust our pricing accordingly. So maybe it's because they plan to increase the pricing of their product, okay? That's the stock went up, but yet, like, they're losing clients. They are not making any sales anymore. They're decreasing the sales, and yet they still want to increase prices. Maybe it's a good strategy, I don't know, okay? But like, it doesn't sound like good news. Like, it sounds a bit strange. We believe we may be well positioned to deal with the changing tariff landscape as compared to our competitor. Our products are principally manufactured in the Dominican Republic and USA, as opposed to China, Mexico, and other countries where final tariff rate could be significantly larger. So maybe it will be a good point, this. I'm not very sure about it. We need to see all the details, but in my opinion, like, then they are not focusing on the right points in this presentation. I don't understand why they don't make people understand what they are doing right now to stop this decreasing in growth. So you will see it right after. So they increase the dividend, okay, 0.14 dividend per share, an increase compared to last paid dividend. So for growth, you have a revenue which decreased by 10.8% year over year, EPS by minus 22%. So it's really bad. Okay, recurring service revenue, it increased by 10%, but yet the expectation from the last report, okay, the last quarter, were 12.5%, and it's only 10.6%. So they are lagging compared to what they actually wanted, to their guidance. They are not respecting the guidance. Like, I really feel like since the last two quarters, the management is decreasing as well. Like, it's being less good. So yeah, I'm curious to see what will happen next. The equipment revenue minus 24.8% and operating income minus 14.25%. The reason why operating income didn't decrease more, it's because they increased recurring revenue, okay? And 49% of their revenue now is from recurring revenue. When it comes to margin, they have a gross profit margin of 57.2% compared to 53.8% year over year. It got higher because the growth in recurring service revenue, okay, which has a 91% gross margin, and more revenue come from software and less from hardware, okay? The revenue from equipment decreased while the revenue from service increased. So that's why you have better margins. Same for EBITDA margin. It's 29.9% compared to 31.6% year over year and 28% last quarter. So yeah, last year it was better. They're really decreasing everything. I don't understand how the fuck he is happy with this. Like, I really don't understand this. Like, if someone can explain me in comment, maybe I missed some information. Maybe there is something that I missed, okay? But how is he happy with this while it's less good, okay? And it's not getting better from before. You have operating margin at 25% compared to 29% before. So it's still high, it's still good, but 25%. The reason for decline here, you can see the net sale, of course, the equipment revenue, which decline, which have less margin, and also they increase a bit research and development, and they increase here in selling, general, and administrative expenses. So that's why they have higher operating expense with lower sales. So of course, the operating margin can only go down. When it comes to capital allocation, they did some share repurchase. I think it's around 3% or 2 or 3%. So it's very good. It's actually good, especially when the price went down like this. It's something very good. So 3.6% buybacks. And it's nice that they accelerated while the share price is down. So this actually is something that I like. From tariffs, it's the same than last quarter. They expect less problem because they supplies from Dominican Republic. But yet, maybe product arriving from China to Dominican Republic. So we need to have more. I think we'll see in a year or something like this if they have a bet really an advantage when it comes to tariffs or not. To conclude, for Napco, before getting to the valuation, last quarter, they seem confident that for H2 2025, equipment sales, so for them it will be Q4 2025 for their one, but for us it's H2, during H2, equipment sales will be resolved and grow again. This quarter, they didn't confirm it. They don't know, they hope. But, okay, there is one thing, they seem confident when they look at the stats about sell-through. Okay, when they look at these stats, they're like, yeah, we are confident. The demand is growing. There is 9% growth or 7% growth. So let's hope the sell-through will be good and it's a good indicator for the future. But for now, like that, nothing to reassure from the last quarter, and it even got a bit worse, okay, in my opinion. So I keep this position because it's 2% of my portfolio. It's, let's say, a little bet on a small cap that, okay, it can do well. So if it do well, it can create something good for my portfolio. But if it doesn't do good, it's 2% of my portfolio. So I don't really care. Okay, I invested mostly to follow the stock and see how it will go. But yeah, it's not something good. Like if you have more than 10% of your portfolio in Napco, I will not sleep well. Okay, if I had 10% here, I will not sleep well. Now let's go to valuation. So with the last earning, okay, the price is 26. We expect a P ratio of 25. Why 25? Because the historic one is around 30 or something like this. I will not go around 30 for this kind of company. So between 20 and 25 seems to be good. Now it's around 21. The share outstanding 35.7 million. Let's say it will decrease by 0.5% per year for the next 5 years. Now they did more buybacks, okay, but historically it's 0.5. So I don't want to go higher, okay, even if they continue to do good buybacks. I prefer to be like this. So with this scenario, you will do 23% per year if they have 20% growth. Okay, it's what was expected before, but now that they don't have any growth in the sales, in the equipment sales, I find the 20% difficult to achieve. Okay, I'm not saying they cannot. Maybe it's just a bad year and next year will start to be better, or in 2 years it will start to be better, then why not? But for now, it sounds a bit difficult. So I think here would be more safe to put 10, even maybe 8%. Okay, 10% you will do 12.8%, and if they have 8, you will do 10.83%. So as you see what is growth rate that you estimate for the net income, okay, if I think for the next 5 years, if we have 8% per year, it sounds reasonable, it sounds possible, especially if it get better in the next quarter, in the next year, about the equipment sales. That's all for Napco. Now let's go to Arista. By the way, this is another format that I do with Arista. Let me know in the comment section if you prefer when I do a Google Doc like this and go on the main point, or when I highlight things that I think interesting in it. Okay, I will be happy to have your feedback about it. So for Arista, they had a very strong quarter. Okay, the revenue at 2 billion is the first time in their history that they passed 2 billion in a quarterly revenue. It's an increase of 3.9% compared to last quarter, and an increase of 27.6% compared year over year. Gross margin, the GAAP gross margin is 63.7%, same than last year, and non-GAAP is 64%, a bit less than last year. The net income, it increased by 27.6%, which is very, very good, okay? And is the same for the non-GAAP approximately. Here, some comment from Chantal Breithaupt, the CFO. We also completed the highest level of stock repurchases in Arista's history, quarterly or annually, at 787 million share, reflecting our strong conviction in the long-term value of the business. And this is smart. The move that the CFO did was actually smart because the stock really declined during this quarter. And for me, it's probably one of my biggest mistakes that I didn't invest. I will show you after with the valuation, but we were at a price that I really liked. I really like this company as well, this business as well. I think the management is very competent and very good, but I didn't buy, okay? For I don't even know what reason. I thought like maybe I think I was greedy. I wanted more. I don't know, but I didn't buy, and this was a big mistake for me. Okay, they accepted an authorization additional program to repurchase up to 1.5 billion. So if all of this happen, it means that they will be able to repurchase approximately 2% during the year of their shares. Okay, so it's good. Okay, 2% of their market cap. It's really good. For the financial outlook, what they expect for next year. Okay, the outlook for the next quarter, not for next year, but for the next quarter, is a revenue of 2.1 billion, which will be a 24% growth compared to last year, and gross profit margin 63% and operating margin 46%. I guess the reason why they decline, okay, it's because they had, if you look at here, the goal for 2025 still at 17% annual growth rate year over year for the revenue, while they had way better for the first quarter. Okay, so they were like, I think the market was expecting them to put the goal higher, okay, to put this instead of 17% growth to have maybe 20% growth. But Arista, their management are very careful with this. They don't want to go too fast, and there is a lot of uncertainty about tariffs, so they prefer to not get into stupid prediction and so on. So that's something important to understand. Here, the operating margin now is 42.8%, the non-GAAP 47.8%, so it's increasing as well. So this is something very good, and the repurchase of common stock, we saw it, it's here. The thing that I like to highlight with Arista is every time that they say, okay, it's going to be like this, it's better. They always have better than expected results. You can see it here. And even for an analyst, if you look at the history, for example, the EPS, you never had since 2021, you never had a bad surprise. It's always a bit better, okay? Here, 10% better, here, 14% better, here, 15% better. They always do slightly better. So when it comes to valuation, now if we adjust, let's say they have a net income, this is a net income that they have, they will grow by 14%. They expect a revenue growth of 17%, plus they also have some the margins that are increasing, so they should be way higher than 14% for the net income. But as I always say, I prefer to take big margins of safety, but we could eventually put 17% here and it will be good. Okay, so let's put 14, okay, by being very conservative. We have a price ratio of 26, same price ratio, it's very conservative. This company most of the time trade over 30 PE, but I prefer to put 26 because I'm not confident in putting in my valuation metrics over 30. Okay, for me it's too big. And let's say they do 1% buybacks every year for the next 5 years. These years they should do 2%, but let's say they will do 1%. The fair value would be $71. The stock touched $59. Okay, during the first quarter, during in the last quarter, it touched in April $59. That's why I'm so pissed that I didn't buy, because I was following the stock. I started analyzing the stock. I just didn't finish my full analysis on the company, but I could open a little position to see where it will go and understand more the business, but yet I didn't. So now the fair value with this assumption is 71%. Now, if you think that they will grow by 18% per year, you have a fair value of $85. Okay, $85, and this is for the next 5 years. That's why I put 14%, because yes, they have good growth potential for the year. They should do more than 17%, but for the year to come, I'm not so sure about it. So 14% seem to be fair and to be very conservative, to not do any mistakes, especially that this company you traded with a big premium. Okay, so that's all for Arista, which is probably my biggest mistake this year so far. Now let's go to the last one, which is Brookfield, that I started analyzing lately. Okay, I started a week ago to analyze this company because it's a great business. They deliver great value for shareholders. So here they increased by 27% their distributable earnings. That's the trick with this one. You cannot really look with Brookfield. Okay, let's have a look here. You cannot really look at net income and so on, because it's not how it works for this company. Let's say if you look at net income, you can see that it's not nice. It's not something you want to see. Okay, it's really not something you want to see generally. But when you look at the way the distributable earnings work, it's way better. Okay, there is a reason why they did such a return for shareholders. It's because of this. In spite of increased market volatility, the outlook for our business continues to be strong, and our focus remains unchanged to deliver 15+ return to our shareholders over the long term. We have accelerated share repurchases, buying back 850 million of shares so far this year. So this is something really good. The price declined, so they profit from this to buy more shares. Distribute earning before realization, you have a nice growth. Okay, it was in 2024 4 billion point 2. Here it's 5.1 billion. Distributable earning from 4.8 billion to 6.6 billion. It's very great. Our asset management business generated a 26% increase in fee-related earning compared to the prior year quarter. So this is really good. Did I highlight something else here? Not really. I will probably do a deep dive into this company. So let me know in the comment section if you would like a deep dive on Brookfield, because it's, I think, a company that I may start a position very soon. We'll see after with the valuation. Here's from the letter to shareholder as well, from I think it's Bruce Flatt, if I don't say something wrong here. The name of the CEO is Bruce Flatt, I think. We also increase the pace of our share buybacks. So again, while the geopolitical environment is more uncertain than 3 months ago, our focus remains the same: find great businesses to acquire, buy them when we can acquire for value, and operate them well once we own them. History has proven through all economic conditions that owning great business for a long period of time is the cornerstone of wealth creation. So this works as well for you, individual investor. Of course, you may not acquire a full business and operate it, but acquiring shares of company, okay, when there is a lot of volatility, when they have good value, even if you don't have any geopolitical insurance or anything like this, it's something good to do. Okay, it's always something good to do, especially if you hold for the long term. So stop wasting your time and your energy on geopolitical noise and so on. When the share is at a good price, buy. You don't care if maybe it will go more down and I will be able to make a better deal. No, just buy. And if it's not too big in your portfolio and you have some cash available after, when it decreases again, you can buy again. That's not a problem. Okay. Here something else. Considering that the S&P 500 has delivered an annual return of 10% for the past 30 years. Comparatively, our shareholders have earned an annual return of 18%. So this is serious outperformance. Again, the buybacks here, and I didn't highlight anything else here. So let's have a look at the valuation for Brookfield. So if we have, let's put it on 5 years. So this is 5 billion point one. It's here. It's a distributable earning before realization. Okay, put before realization. If they grow by 18% per year, their goal is to grow by 20% per year. Okay, so if they grow by 18%, it's more conservative. Let's say they don't do any buybacks. Okay, they did buybacks now. They will not do buybacks for the next 5 years. And if we have a price ratio of 15, now the price ratio is 16. Okay, so let's say they don't increase the price ratio. We stay at 15, while if you compare to competitors have higher price ratio. So we keep 15 because we want to be very conservative. The fair value here to do 13% per year is $65. So if you buy now, you will probably do something around 15 to 16%. So in my opinion, if you like business, if you like Brookfield business, $57, it's a nice price to pay. Everything which is under $65 seems to be a nice price to pay. You can see some full analysis about this company on Pershing Square report. They explained their full thesis on Brookfield. It's very interesting to know. And you have a guy named Daniel Pronk, which have a YouTube channel which did a lot of video about Brookfield, so you can understand better the business with all of this. If you would like a deep dive in this company, let me know in the comment section, and I will see you in another video. Bye.